the sanctions by the US on Russia is starting to get an impact on the metals market. And there's obviously a major demand building because of all this AI development that we're having, that copper is a big input into any type of semiconductors, other computer chips. So I think it's a global macro story that's going to drive things.
It's Monday, May 20th, 2024, and this is Markets Daily, a show where we get into the minds of some of the smartest and most experienced investors, traders, analysts, economists, CEOs, and basically anyone with a hot or a smart take on what's going on in the crypto markets. I'm Jen Sanasi. Before we get into our discussion today, let's take a look at what's going on in the markets. ETH and Bitcoin are trading relatively flat this morning. The consolidation is followed by a bullish week. Last week was triggered by renewed optimism about a U.S. rate cut and the rally in stocks. We're going to talk about that in just a few seconds. It also seems like the market's preparing for a potential ETH ETF rejection. So as we've been talking about on this show, the SEC is set to weigh in on VanEck Ether ETF on May 23rd. Polymarket has set a 10% chance of an Ether ETF being approved by the end of the month, 13% chance of one being approved by the end of June, and 28% of one being approved sometime this year. Let's make sense of this and more with NewEdge Wealth Senior Portfolio Manager Ben Emons. Ben, welcome back to the show.
Good morning, Jen. It's great to be back. Thank you for having us.
All right, we start the show now with the call of the day. What's yours?
It would be copper in this case. There's a big surge going on, and on the one hand, this is very technical because copper is traded at two exchanges, right, in London and in New York. But that's actually not really the story. The real story is that the sanctions by the US on Russia is starting to get an impact on the metals market. And there's obviously a major demand building because of all this AI development that we're having, that copper is a big input into any type of semiconductors, other computer chips. So I think it's a global macro story that's going to drive things. And if you look at the stock market leadership, there's actually really shifted now. The semis are more lagging behind now, and the copper and metals and gold are really taking the lead, I'd say, in terms of return relative to the S&P index. I think that's meaningful because typically a rally in metals means, in market lingo, reflation, is in, you're getting somewhat of a boost to commodity prices. And it could be a positive thing for the time being for markets. And I think we should take note of it. It's an interesting development, and probably going to affect the markets from here.
Make the connection for me. Is there a correlation between metal and the crypto markets, or metal and risk assets?
Yeah, there is actually, and I would say particularly in this situation, because the semiconductors have been such a powerful force behind the market rally, and as a result, because of all the AI hype, the financial conditions in particularly the United States, but somewhere else, have all loosened, even though the Fed is supposedly be tight in its policy. Now, if you then connect the metals picture to that, what is really happening is, if metals are driving financial conditions, the link with crypto is that crypto and financial conditions have had a correlation now for several years, a positive one. That's because there are more and more companies out there that are using crypto for service or as an asset on their balance sheet. So if you're getting metals rallying and losing financial conditions, and financial conditions getting looser, then crypto markets are getting elevated too. And if you then add in the discussion you just had about the ETF launches, then you can see the mix all coming together. So this is your typical global macro, Jen. It's like one variable rallies and then affects a lot of other variables.
All right, let's broaden it out a little bit more. I know the last time you were on the show, I asked you this exact same thing. But given what's going on in the markets this morning, how would you be looking at allocating a portfolio?
So we'll still remain in a, let's say, positive risk on tone. Um, One, if you think about interest rates, because that's what I focus on particularly, I'm still quite wary of where treasury yields are heading. There's a lot of fluctuation. So if the Fed's on hold, there's a lot of opportunity in riskier fixed income, let's say structured credit or emerging markets or floating rate debt. That's one side of the portfolio. The other side would be that the risk on tone has led to equities continue to set new highs without seeing a major bubble yet appearing, or any kind of major valuation inflating such that it becomes concerning. We like particularly energy and financials in that aspect. But you can now start adding in some of the commodities underneath the energy. And if you think really further down through, which would not as a firm position in, but there's also a lot happening in agricultural commodities too. So the commodity rally that we're seeing, I think for the time being will be with us. So hence energies are one of our favorite picks.
I want to talk about inflation. I mentioned at the top of the show there, markets were looking pretty optimistic last week as there's this renewed optimism. We may see a rate cut this year in the United States. Because you focus so much on inflation, I'm just curious to hear, is there something that we're not talking about that we should be when it comes to the macroeconomic data that's coming out and as it pertains to inflation?
Yeah, I would think that the narrative that's come about of either stagflation or major slowdown or slowing down the economy, that seems to be all, I think, somewhat misplaced. One, actually the data that's showing is just really a temporarily softness, and it's very much at the top line. If you think of retail sales or even within the inflation number in itself, there's nothing that indicates that we're really decelerating with activity sharp or faster. So there's nothing also about some sort of a stagnation happening while we have inflation. Unemployment remains low. The jobless claims continue to be very subdued, which is a really good indicator of the health of the labor market. And this so-called surprise index that people look at, the economic surprise index, although that measures, whether a number comes out higher than estimated or or lower than estimated in some sort of index, it's more like a diffusion idea, what the economists say, meaning it just shows you some sort of a trend of the economy. So it looks like the momentum maybe of the economy have somewhat stalled out. But if you're getting a stock market that's up this much this month already and financial conditions are loosening, there's going to be an effect on the economy in the next quarter again, which is likely positive. If we have no change in fiscal policy by continuing the spending that we're seeing, and monetary policy is on hold, it's not going to raise rates but not cut either. There's actually not much that's there for the economy to slow down. So I think the slowdown, stagflation, so to speak, I think is misplaced.
It's interesting you say that. Now, look at this through the lens of the crypto markets with me. You say the next quarter is going to look pretty positive for markets in general. What do you think happens with crypto markets? Because last time we talked, I believe the ETFs were recently approved. The markets were doing really good. There's been some ups and downs since then. How do you see the crypto markets reacting?
Yeah, as I mentioned, so that correlation between crypto and financial conditions or the equity market is there. So you could say that that's the case, that crypto should lift higher. There are obviously those fundamental factors that you talk about. I mean, if crypto goes up in value, those ETFs will get inflows, and the institutional community that's completely underweight that's the crypto sector in itself would then start adding Bitcoin ETFs and or adding Bitcoin in by itself, right? So in other words, there's a bit of a self-reinforcing mechanism there between crypto and the markets. There's also something about liquidity, by the way, that I didn't mention, was that we have the Treasury, who have built up a huge balance at the Fed, is now starting to spend that down because they have to. They have to do that by legislation. But that money enters into the system. Now the Fed has recently announced that it slowed down its QT program, quantitative tightening. So that's actually money coming re-entering in the system. And if you then get everybody on the sidelines, started putting some money to work in the markets, there's money entering the system. That's where crypto is really sensitive to, and it's been traditionally that way, and I think it hasn't changed. If liquidity picks up significantly, crypto will pick up. And I think that's what we're in for, somewhat of a liquidity expansion that should lead to a better performance of crypto.
Now, I know that you're not always afraid to give a price prediction. Some guests on this show are. Where do you where do you see Bitcoin headed by the end of the year? I think the last time we spoke, you said it could hit $100,000.
Yeah, I've said it in your show, and it was another show I said it too, and it's out on the headline, so I can repeat the headline. Like, basically, I said sky's the limit because it is sky's the limit, right? And I mean, and the reason why 100,000, which some people have said this in the past, the late great Scott Miner, for example, from Guggenheim, he mentioned numbers like that. I base it upon now that this is really driven by fundamental flows coming in that asset class. If it's regulated through an ETF, that is a very important step forward to fundamental investors buying the asset class instead of all the speculators. I think that's why there's a scope for going to 100,000. Now, when we're going to reach that, I don't know. But it seems to me like some sort of a benchmark, right? We hit a little over 70,000. We broke the highs, but it seems that that's not really where we're going to end up. It seems more momentum behind it. As I mentioned, all those other factors of what's going on in the markets probably helped crypto getting to a higher level. So an even level of 100,000 is very possible. From there, who knows? If we're hitting 40,000 on the Dow, and when I started working in the 90s, that was, I think, 5,000, then why couldn't crypto go higher as well that way? Right? If you think of that sort of historical context.
Ben, we've been really optimistic so far on this show. Any challenges you see ahead when it comes to the crypto markets?
Well, always the challenge is that if we're getting an economy again start to heat up and things start to get like more and more momentum, that the discussion about rate hike or hikes comes back. That will be the first, say setback for crypto. That asset class will react more sensitive to the prospect of hikes than maybe other asset classes. There's something to keep in mind. People keep saying there's no hike, it's not going to happen, but it could happen. The Fed members have indicated they would be willing to if inflation doesn't go that direction. The second thing would be that we do get some sort of a political or geopolitical tension that really puts the focus on safe assets that may be somewhat of a detraction to crypto. Like, gold has had a major run, and it could be the case. I've seen this before, gold rallying and Bitcoin actually going sideways or lower, maybe because people flock more to gold than to a crypto as a safe asset. I think those are the two I think we have to look at. Who knows how this is going to play out? It seems for now we're in a very benign environment for the time being. But we know that this big election in the US is coming, and we know that there are tensions in the Middle East that are not dissipating, as we saw with the developments in Iran overnight. So I think we should, as investors, keep in mind that the benign environment never lasts forever. So
I think that's a great advice that you've just given there, Ben. I got to ask you, what do you think is the potential that we see a rate hike this year?
it's there. It's an option on the table. It's a really tiny probability that's priced into the futures market, which always happens. Is a bit of a technicality. If people think there's rate cuts, there's going to be someone else thinking there's going to be a rate hike. That's just markets. But that probability does tell us something. There is something about awareness of if a Fed member or two, three have indicated that there is a possibility they may have to raise rates, then that will be continue to be on the mind. Now, will it happen? Totally depends on how inflation goes from here. So far, it looks like it has stalled out and doesn't decline much more. So if it were to start to pick up, like we've seen the first three reports this quarter, and then this last one was a little softer, but we pick up again from there, then the possibility for a rate hike just by incrementally goes up. The Fed will still be very reluctant, though, to hike rates. They much more like to cut rates. That's not the political. That's more about they want to reach the inflation goal close to it, then they can cut rates. And they've shown to the world, I guess, our policies worked. If they have to hike rates, it means that they were once again behind the curve. But if inflation doesn't go that direction, then the Fed will move that direction to hikes. They would have no other choice but to do that to maintain credibility. So I think we need to keep it in mind that it's a possibility.
It's always a pleasure hearing from you. Thanks for joining the show this morning.
Thank you, Jen. Great to be with you.